One of the biggest mistakes that I see new investors make is that they confuse a great company with a great investment. These two things are not the same, and you can certainly invest in a great company and end up making a terrible investment. I would almost go as far as saying that most of the time, a great company is not a great investment. So in today's video, I'm going to demonstrate the key difference between a great company and a great investment. I'm also going to be showing you a case study of a real company, a great business that turned out to be a terrible investment for over a decade. And then finally, I'm going to share a solution to this, how you can identify a great company versus a great investment. And of course, make sure that you're not just investing in a business that is not going to deliver you great long-term returns. I put a ton of effort into making this video, so if you do enjoy it, I would very much appreciate it if you could take the time to just leave a like on the video, leave a comment down below if you want, and I'll be down there answering questions as this video goes live. But for now, let's jump into the video. There are many companies on the stock market, most of which I would consider not a great company, but there is a substantial amount of companies that meet the requirements that I have for what I would say is a really strong fundamental business. And a couple of the overarching concepts that we're talking about here, I think are quite fairly easy to understand and fairly easy to identify in a business. We're talking about things such as a management team that cares about the long-term success of that business, which means we're often looking for businesses that have founders that are still running the company, or a manager that has been working at that company for a couple of decades or something like that. We're looking for a management team that consistently makes good investments within the business, which makes perfect sense. We want the management team to take our money and compound it within the business and grow it over time. And of course, we're looking for businesses that have distinct competitive advantages. And more often than not, a really great company will have multiple competitive advantages, something unique about them that is attracting customers. And we will ultimately see that competitive advantage backed up in the core growth of their numbers over time. Because if they do have an advantage, they will be attracting those customers in and growing consistently and often at a high rate over time. But if you just invested in every single company that met those requirements, you would probably still not make a good long-term return. And the reason why is because a great company is not the same thing as a great investment. And the idea around the difference between these two is relatively simple. The difference is the price that you pay for that investment. When you invest in a stock, you are buying part ownership of a company. And in that process, you are outlaying money in the hope or in the expectation that you get more back in the future, right? That's the core of investing. And really great companies produce really great streams of cash flows and profits for shareholders. But ultimately, as an investor, it's not the absolute amount of cash flow that a business is producing that matters. It's the relationship between the amount of cash that that business produces and what we have to pay in order to buy a piece of ownership of those cash flows. And when it comes to great companies, more often than not, that relationship between the price you pay and what you get back from that business over the long term is terrible. You might have seen someone on CNBC or some other kind of investing show say something like this: investors are paying a premium to invest in Apple stock, which is really just code for more people want to buy Apple stock, therefore Apple stock goes up. And this is the case with most great businesses on the stock market, because a great business by definition is probably performing quite well, and as a result, more investors are attracted to invest in that business. And the problem is that the higher the stock price goes, the worse that relationship gets between what that business is producing and can deliver to you and the price that you're paying. Because ultimately, if more people want to buy Apple stock and Apple stock goes up, do you think that has any impact on how much cash the business is actually producing? No, they're two completely different things. One is a market for people trying to buy ownership in Apple, and the other is Apple's actual business. And even though over time they generally move in the same direction, in the short term, they can move in completely different directions. And this can get so extreme to the point where you could invest, or you could have invested in one of the greatest and biggest companies on the US stock market and seen negative returns for over 16 years. So to draw on this case study, let's take ourselves back to 1999 at the height of the dot-com bubble. There was hundreds and even thousands of new internet companies coming onto the stock market all the time. And these companies made no money. They had no way of making money in the future. And they also had stock prices that were extremely high because people were very, very hyped about internet companies and the future of the internet. But none of those companies are the case study that I want to discuss today because, of course, none of those businesses meet the requirements of a great business. But there was one company in 1999 that did, and that was Microsoft Corporation. Microsoft was founded in 1975 and went public in 1986. So much like the Googles and Facebooks of today, Microsoft had been public on the stock market for over a decade before the dot-com crash. And the company was profitable. So from 1996 to 1999, the company was able to increase their revenues from about $9 billion to $20 billion, and they could increase their profits from about $2.2 billion all the way up to $7.8 billion in the space of just a couple of years. An intelligent investor at the time would have looked at Microsoft and thought, wow, this is a great company producing billions of dollars in cash flow, clearly has some distinct advantages and run by a great management team, but it's too expensive relative to what you have to pay for the stock. The stock price peaked in 1999 at about $57 per share, and at the same time, the company had just about $1 per share of earnings, which meant that their price to earnings ratio was upwards of 55 times their current earnings. And what happened next was, of course, devastating for investors. So in the 12 months after that peak in their stock price, the stock went down 60%, and then it continued to decline all the way into 2009, where it was down 70%, and then it did not recover to that $57 peak until 2016. And the amazing thing about this story is that you might think, oh, a company that saw 17 years of negative returns, the business must have stopped growing, or they must have started losing money, or at the very least, they must have substantially slowed down in terms of their growth. But none of those things are true. Microsoft continued to grow their revenues and profits in almost every single year. Their revenue went from $20 billion in 1999 all the way up to $90 billion in 2016. And their profits did a similar thing, which tripled over that period. What ultimately happened wasn't that Microsoft's business suffered in any substantial way over those 15, 17 years. What happened was the stock itself suffered because its price was previously too high relative to what the business could actually deliver to investors. At the end of the day, if you're paying something for a stock, you're expecting that it's going to deliver you returns back to you. And when those returns don't come, people sell the stock. They move into other businesses, and that is ultimately what happened to Microsoft's stock. It got too expensive relative to what it could not even reasonably, but at all produce over the next 15, 20 years of its business. So what's the solution to this? How could you have possibly known that Microsoft, as great of a company as it was, that its stock was going to go down or be negative for 17 years? And before I get into sort of the way I navigate this, there's no way for us to know that Microsoft's stock was going to be negative for 17 years, for example. The behavior of the stock price is something that is unpredictable in the short term. Over the long term, it will reflect how much profit the business produces for shareholders, but whatever happens in the short term is unpredictable. So is there any way for me to have known that $57 was their peak? No. And there was equally no way for me to know that in 2009, at the very bottom, when they hit about $16 per share, there was no way for me to know that that was the exact point at which the stock was going to rise again. But there is a way to make great investments and avoid investing in great companies that are not great investments. And I think the concept is fairly simple. It's much trickier to execute in practice. But the core of the concept or the principle is that you need to have a calculation to look at the relationship between the price you're paying and what that business can produce for you. So in other words, what is the price that I have to pay? What money do I have to outlay to get ownership in this business? And what cash flows is it going to deliver to me? What am I going to get back over the next 10 years? And from what I've seen, most of the time, great companies have a terrible relationship between their price and what they can actually deliver to investors. And as we spoke about earlier, that makes complete sense because when a business is a great business and they're performing really, really well, investors are attracted to it. That bids up the price. And then you have this relationship between the price you pay and what it can return to you. That's not very good. So in other words, the long-term return you're going to make if buying at that high price is likely not going to be very good. Or in the extreme case of Microsoft, it was negative for well over a decade. However, there is a silver lining here, and that is that these great companies that are most of the time not great investments, they can quickly become great investments when there is some kind of short-term problem going on either at the company, at the entire industry, or in the entire stock market, some kind of overall economic problem that's pushing down stock prices broadly. So to continue on with our Microsoft example, remember back in 1999, Microsoft stock was really hyped up and it was trading at about 55 times its earnings per share. Well, in the kind of opposite side of the coin, during the global financial crisis in 2009, when everyone was panicking about stocks, the stock was trading at about 8 times its earnings per share. So those two kind of represent two extremes. One where we're at the height of the dot-com bubble, everyone's excited about tech companies, and Microsoft stock gets dragged up with that, even though, the relationship between the price and what they can produce wasn't very good. But then all the way in 2009, the business was still a very, very powerful business and was growing at a high rate, but people were willing to pay a lot less. And you could have invested in that company at a substantially cheaper price relative to its earnings than you could have at any time previously. So ultimately, what you want to do is build a watch list of businesses that you deeply understand and can therefore identify as great businesses, and then recognize that most of the time those businesses are going to be at prices that offer a really low return or even maybe a negative return. And you need to have the patience and the discipline to wait for a business-specific problem, an industry-related problem, or a global economic problem or a country-specific economic problem to push the stock's price down so that you can not only invest in a great company, but also make a great investment that's going to deliver to you significant returns over the long term. As I said at the start of the video, I put a ton of effort into this one, so if you did enjoy it, I would very much appreciate it if you could take the 2 seconds it takes to hit the like button, hit subscribe if you want to see more content like this, and as always, I will be down in the comment section answering comments as this video goes live, so feel free to head down there, share your thoughts on the video, any feedback you have, or if you have a question about investing in general, I'll be happy to answer any questions that you have. But other than that, hope you guys have a great day, and I'll see you in the next video.